everything I've described gives Bitcoin a narrative problem. Because people are going to say, oh, well, in the last year, it hasn't been a great store value. It didn't save me when geopolitical uncertainty rose. It didn't save me when we got uncertain about this new Fed. And of course, in the back of people's minds is this idea quantum risk are growing for Bitcoin. So it does raise that narrative question. But the one thing that we do know now is that both Bitcoin and Ethereum have had a huge drawdown.
Usually when it tops out, it actually tops out on apathy rather than euphoria. And so because of that, there's not then a rotation into higher risk assets. Because what happens is we start with the higher risk assets, altcoins bleed to Bitcoin, then Bitcoin bleeds to stocks, and then stocks bleed to gold. It just kind of rolls down the risk curve.
Bitcoin remains around $67,300 as of February 20th, up 1.4% over the past day, following a dip to $66,370. Hedge funds are pivoting to cash amid fragile ranges, while the crypto fear and greed index reaches extreme fear levels due to heavy volatility and ETF outflows. Hash rate rebounds after the winter storm Fern plunge, setting up a key downward difficulty adjustment this weekend, February 19th to 20th, which should lighten mining strains and bolster network security short-term. Tom Lee, in a recent interview, argues that Bitcoin finds itself in a difficult narrative moment. Critics question its store of value credentials after it failed to shine during last year's geopolitical shocks, Federal Reserve uncertainty, and a growing backdrop of quantum security concerns. Yet both Bitcoin and Ethereum ultimately survived massive drawdowns, revealing a resilience that often gets overlooked. History backs that up. Bitcoin's rolling returns have consistently outpaced inflation, while gold has lagged in 15% of all 3-year periods. Ethereum, for its part, suffered a brutal 60% drop, its 8th such plunge in 8 years, but its recovery patterns continue to echo past cycles. Beneath the volatility, the metrics tell a far brighter story. Wallets, on-chain activity, and real-world asset tokenization are exploding as Wall Street accelerates its push toward faster settlement and digital finality. According to Lee, markets may still be wild, but Ethereum's rebound rhythm persists, and gold may have won the first battle of 2026, yet the longer war for modern value storage is far from settled.
Bitcoin has been in a drawdown really since October 10th, and we know that on October 10th, there was a price shock then that led to one of the largest ever deleveraging events. And so the industry has been crippled since because balance sheets have shrunk. About a third of the industry's market makers went away, and crypto sentiment, of course, has turned really negative because about at least 2 million accounts got wiped out during that mini crash. And so the industry has been limping along. And I think then a few things happened earlier this year that sort of triggered another cascade of not necessarily deleveraging shock, but essentially what looks like capitulation. The first is that President Trump made a tweet about Greenland in January, and that triggered another cascade of liquidations because you had another price shock that happened over a weekend. And as we know, liquid markets will sell what they can over a weekend ahead of a broader market opening, and that was crypto. The second is that as markets became very leery about geopolitical tension, and then of course dollar weakness, and but then it got magnified that we had a potentially new Fed chair coming in that looked that he could be quite hawkish. I think that led to a real rethink about how people want to be positioned. And as you know, gold suddenly surged. And that gold surge became quite expensive for investors because gold has about a $30 trillion network value now. Gold surged almost 20% in 2 days. That was a $6 trillion swing for gold. Well, the entire crypto market is about $2 trillion. So gold made a very large volatile move over a weekend, which again could have triggered another set of margin calls for anyone short, especially gold and silver. And then crypto, of course, was really the source of funds. So I think in many ways, crypto still hasn't recovered from October 10th. And then we had what I consider some macro shocks that got people really interested in gold, but there's so much gold held that you had to sell something else to actually own your gold.
Isn't this kind of the market telling us actually Bitcoin isn't the new gold? Actually, gold is the new gold?
Yeah, that's a great question. I mean, that has been the existential head scratching, because a lot of people in crypto say, hey, isn't Bitcoin supposed to track gold if you have geopolitical tension or central bank easing, or we're talking about dollar debasement? But there is one scenario where gold will do well, but crypto will do poorly, okay? And that's if the entire currency system itself is questioned. Meaning, if there is a point where we say, we're so concerned about chaos that I don't care about the dollar. I don't even want to own anything that's dollar denominated, and especially if it's a digital dollar, right? Because Bitcoin is digital money. In that scenario, gold would do well, but stocks and crypto would go down. So I think in some ways, the market became convinced itself of the idea that, gold's going up so much because we could be facing a much more calamitous scenario. And I think part of that has to do with Warsh was kind of a little bit of a shock to markets. So absolutely correct. But the second thing to keep in mind, so that's one scenario where crypto would do badly, stocks do badly, but gold does well. But the other thing to keep in mind is that if you look at rolling 3-year history, Bitcoin is still positive and outperforming inflation, which means Bitcoin is still actually a good store of value. If we look back at the history of gold, I think it's about 15% of the time, gold's had a negative rolling 3-year return. So in some ways, both are stores of value, but they're just going to be working at different times.
You've also been an investor in Ethereum, which has also gotten hit recently. What are your views on Ethereum at this point and its relationship with what's happened to Bitcoin?
Well, yeah, Ethereum has really been caught up in the crypto sell-off because it is the second largest crypto. So if anyone is trying to liquidate their crypto holdings, and there has been capitulation, people saying, I'm really done with crypto entirely. So they're going to sell their Bitcoin and Ethereum. And I think we're in that phase. The difference, I think, is that Ethereum actually does have measurable activity that we can look at. We can look at wallets opened and created, transactions done on the Ethereum network, or even the amount of assets created on the blockchain, which is called real-world assets or total value locked. Those have actually all been rising and actually going up parabolically, because Ethereum is benefiting from Wall Street's focus on tokenization. Tokenization is the idea that Wall Street wants to redo parts of its business on a public blockchain because it actually speeds up the product and it reduces delays. It's what they call finality. And so Ethereum's really benefited from that. We know, just for instance, this year alone, BlackRock has announced its further support of creating a common blockchain. We know that the NYSE is tokenizing its assets, and they are working with public blockchains to implement that. And we know Fidelity launched its own investment fund on the Ethereum blockchain. So I think there's a lot of actual, strangely, and maybe this is going to bother some original crypto people, but Wall Street is really embracing Ethereum. I think it is correct to say that Bitcoin, everything I've described, gives Bitcoin a narrative problem. Because people are going to say, oh, well, in the last year, it hasn't been a great store of value. It didn't save me when geopolitical uncertainty rose. It didn't save me when we got uncertain about this new Fed. And of course, in the back of people's minds is this idea quantum risks are growing for Bitcoin. So it does raise that narrative question. But the one thing that we do know now is that both Bitcoin and Ethereum have had a huge drawdown. Ethereum's fallen 60%. That's the 8th time in 8 years. So they're both super volatile assets. It's a little bit like when someone says, I want to own Mag 7. So let's say someone says, I have geopolitical uncertainty, and this time gold really worked. And, there's times when someone's buying Mag 7 and they want to buy AI, only 3 of the 7 names are working. I do think we just have to be mindful that 2026 hasn't played out yet. So if Bitcoin indeed stages a recovery, then it's going to recover its narrative. But similarly, we think Ethereum is is really tracking past declines. So we think it's going to recover strongly. But you're absolutely right. In this battle, gold has won one, Bitcoin's lost 0 in 2026.
Bitcoin has been sliding since the October 10th price shock, triggering one of the largest deleveraging events in market history. Balance sheets shrank, a third of market makers disappeared, and roughly 2 million accounts were wiped out, crushing sentiment and leaving the industry limping into the new year. The pain deepened when Trump's January Greenland tweet sparked weekend liquidations in thin markets, accelerating sell-offs as geopolitical tensions, a weakening dollar, and fears of a hawkish Fed chair fueled capitulation. Then gold erupted nearly 20% in 48 hours, with $6 trillion coursing through its $30 trillion settlement network, overshadowing crypto's $2 trillion cap. The squeeze in gold and silver shorts forced traders to pull liquidity from crypto, further dragging digital assets lower. Ben Cowen, in his latest lecture, frames this move within a broader macro rhythm. During quantitative tightening and high-rate bull markets, tops don't arrive on euphoria, they arrive on apathy. The classic rotation into higher-risk alts never materializes. Instead, everything bleeds down the risk ladder. Altcoins drain into Bitcoin, Bitcoin drains into equities, and equities finally capitulate into the ultimate safe haven, gold.
Let's go ahead and jump in. So I think what what people are experiencing right now is, as we call it, a classic case of the bear market blues. And essentially, there's a lot of apathy in the market right now, especially off the back of this non-euphoric top. A top very similar to the 2019 top, in the sense that it happened 2 months before quantitative tightening ended. It happened while rates were dropping as well. So you can look at interest rates were also dropping back then, and Bitcoin still fell. You can look at the total assets. If you look at total assets of the Federal Reserve back then, you can see we also have a very similar thing where, quantitative easing had started, QT was over, but Bitcoin still went down. And that's kind of the same thing you're seeing right now, where Bitcoin's going down despite the fact that QT is over. And this was the whole point of what we talked about all these years about this 2019 comparison, is that when you have a Bitcoin-led bull market during quantitative tightening and high rates, usually when it tops out, it actually tops out on apathy rather than euphoria. And so because of that, there's not then a rotation into higher risk assets. Because what happens is we start with the higher risk assets, altcoins bleed to Bitcoin, then Bitcoin bleeds to stocks, and then stocks bleed to gold. It just kind of rolls down the risk curve. And so now Bitcoin has already dropped 50% from the high, which historically, there's worse times to buy Bitcoin than when it's down 50% from the high. In 2019, we had about a 50% drop. We got into the rally, and then, of course, we had the pandemic where it ultimately went down more. But I think the reason why, this does feel like a classic case of the bear market blues is because, whether people believe it or not, whether people on social media, no matter what they're posting, if they're super cycle posting or permabull posting or calling out the bears for being too bearish, everyone has to know deep down that there's a good chance this midterm year is like all the other midterm years. And what I mean by that is when you look at, say, yearly candles of Bitcoin, when you look at yearly candles, what you'll notice is that the red years tend to be the midterm years, right? 2014, 2018, 2022, 2026. Now, some people have pointed out that because 2025 was red, perhaps 2026 will be green. I don't think that's the case. Bitcoin still had an all-time high in Q4 of the post-halving year, which is when it always does. And I think there's an argument to be made that Bitcoin did not go up as much as it could have, perhaps because there was a lot more uncertainty this cycle. There was a lot of, there was a much tighter monetary policy this cycle, which is one of the reasons why the rest of the market the rest of the crypto market did not really participate in the bull market, except for a few cryptocurrencies. So I would argue that there's a very high chance that this year is a red year. And I know there's people on the other side of it that wholeheartedly believe that in the super cycle idea, and some of them that used to discount the idea of the 2019 comparison, funnily enough, are relying on the 2019 comparison, right? They're basically saying, all right, if we're here, then hopefully this can just be over soon and then we can resume the bull market because let's assume we don't have a pandemic crash, right? Which is not like the worst assumption. The problem is assuming that this downtrend has to match this downtrend when this uptrend in 2019 was not anywhere close to being the same that we got this cycle, right? So I almost wonder if it makes sense to just say, look, in a bear market that tops on apathy, you get slightly lower lows and slightly lower highs. You don't necessarily get that immediate 70% drop from the highs, which was characterized after you get euphoric tops, right? When you get euphoric tops, you pretty quickly get 70% drops from the highs. Under non-euphoric tops, you get slower bleeds that occur. Now, we always said 60 to 70K was going to be a pretty important level because 60 to 70K also corresponds to the prior all-time high, right? Like if you go look at the highs from the last cycle, that's where those highs were, right? 60 to 70K. And this is why all along I said that, look, a 50% drop is reasonable in terms of the 2019 comparison. And it just simply gets us back to where we were last cycle. Now, one thing to note is that last cycle, we actually went below the highs from the cycle before. So it's not impossible for Bitcoin to drop below these levels, maybe eventually go to the 200-week moving average, perhaps go below the 200-week moving average like it did last cycle. The reason why this is a classic case of the bear market blues is because no matter what anyone says on social media, deep down, everyone sort of knows there's a really good chance this midterm year is just going to be like every other midterm year and be a bear market. And the difficult part with accepting that is that it's only February. And we're not even 2 months into the year, and the realization of it being a bear market is hard for some people to accept. For other people, they've accepted it for months. For others, it's harder to accept. I want to push back a little bit. I mean, I do think October is the most likely time for a low, but that is subject to change. I mean, if everyone just gives up and capitulates quicker, there's a chance Bitcoin could bottom before October. If you look at the S&P 500, which we frequently compare to and use the S&P to then learn about what Bitcoin may do, there's times where the S&P bottoms in October, just like it did in October 2022, October 1966, October 1974. But there's occasionally where the market bottomed in May. So, like in 1970. 1970 was when, I believe it was when Arthur Burns was the Fed chair. And he got put in, I believe, in early 1970. And the market ended up bottoming out, going higher. And then eventually we had a collapse. But it took a while and to a slightly lower low. So I want to say that the most likely low for Bitcoin, in my opinion, is October. But the second most likely time for a low could actually be as early as May. So if you do have a classic case of the bear market blues and you're just sitting there thinking like, gosh, how long? We have to wait another 7-8 months. There's a chance it happens sooner. And I just want to say, like, if Bitcoin ends up, dropping below the 200-week moving average and it's May, and if Bitcoin is, say, like if we're looking at the balance price, like if you look at the terminal price chart on the terminal, we're not looking at the terminal price here, but if you just look at prior bear market lows tend to go below the realized price and the balance price. And if we're in May and Bitcoin is below the realized price and it's below the balance price, it would probably be hard to be deterministically bearish at that point. It already makes sense to not be as bearish as Q4. Right? Like Q4 was the easy time to be bearish because that's when Bitcoin always tops. After you have a 50% drop, it makes sense to be a little bit more open-minded to at least some short-term upside, because a lot of times when Bitcoin gets 50% drops, there is short-term upside, just like there was after the 50% drop in 2019.
Ben Cowen describes the current vibe as classic bear market blues, with widespread apathy hitting after a non-euphoric top much like 2019's. It peaked 2 months before quantitative tightening ended, amid falling rates, yet Bitcoin still dropped despite Fed total assets signaling similar shifts. QT has now wrapped up, but the decline persists. Bitcoin's down 50% from highs, regardless of social media super cycle hype or permabull posts. Last year's red close and muted Q4 all-time high, amid tighter policy that sidelined most alts, bolsters the case for another down year. Non-euphoric tops bleed slowly with lower highs and lows, not sharp 70% plunges from euphoria. 60 to 70,000 aligns with prior cycle peaks, making a 50% retrace logical to reset there. The last cycle dipped below those levels and the 200-week EMA, so more downside is possible. Apathy reigns because it's only February. Acceptance varies, but Q4 bearishness eases post 50% drop, opening short-term upside like 2019. Cowen pegs October as prime low territory, mirroring S&P bottoms in 2022, 1966, 1974. May's a wild card, as in 1970 under Fed Chair Arthur Burns. If Bitcoin breaches realized and balances prices by May, below 200-week EMA, it'd signal capitulation, shifting from Q4 determinism to balanced views. What do you think? Can Bitcoin shake off its digital gold doubts for good this year, or will gold keep stealing the spotlight in uncertain times? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.